Great.
Good morning, everyone. I'm Vince Lancy, and today's morning meeting, we will be going through some big picture charts from the Crescat investor newsletter. And we'll also be looking at some market driving news. But first, let's look at the markets themselves. I'll give you a chart to look at while we're doing that. Let's put up silver. The dollar is at 104.28, up 24. 10-year yields are unchanged. The S&P 500 is down 26 at 52.60. The VIX is 1382, up 70, a little bit stronger overnight. Gold is down 22.9, 23.27. Silver is 29.71, down $1, 3.5%. Copper is 4.54, down 11 cents, 2.4%. WTI is down another $1.14 at 73.11. Natural gas, 259, up 3 cents. Bitcoin is 68,900, flat essentially. Ethereum is 37.62, down 3 handles, nothing big. Platinum, palladium are both down. Palladium is down $7 at 9.16, and platinum is 1,008, down $3. Grains are all down. Wheat down the most. Everything else pretty much unchanged. So soybeans are 11.75. Corn is 4.34, and wheat is 6.77, down 5.5 cents. All right, so if you look at that chart, not that chart. If you look at the that price scenario there, you take everything together, you're looking at a marketplace as a whole that's looking at deflation risk, disinflation risk, or recession risk. Now, in a recession, when you look at recession risk, you say, well, stocks should be up because the Fed's going to ease. Well, if you're in a recession risk, which we are now, at least that's what the market's pricing in, you wouldn't normally have a stock market that rallies on the hopes that the Fed would be easing. But the market is progressively afraid that the Fed's not going to ease. And so you get a stronger dollar as people say, well, if I want to get 5%, I'll keep my money in cash. You say, well, if the Fed's not going to ease, I'll take my money out of stocks. And bonds are mixed. You might see a sell-off in bonds. You might see a rally in bonds. The sell-off in bonds would come from the fear that the Fed won't ease. The rally in bonds would come from people looking more at, say, something more global that's deflationary in terms of risk. A war would be supportive of bonds normally. Gold and silver coming off tell me that and copper coming off tell me that when you take all this together, there's bearish economic news coming out of Asia, rumbling. I don't know what's going on in Europe right now. I know that they want to ease, and domestically in the U.S., you have recessionary forces. Oil is the key. I think if you're looking at Asia and you're looking at Asian economies, oil's the key, right? So oil took a hit yesterday. Oil's taking a hit today. And I think oil is weighing on the economies, not necessarily China because they buy the oil, but economies like Russia and Saudi Arabia. And I think you could have a recession coming out of there. You could have a little bit of an Asian contagion coming out of China. Anyway, it's only 2 days of this, but I'd be wary of it because if oil keeps, put it this way, if oil keeps staying down, if oil keeps dropping, as I expect it would be going into an election because wink, they can do that, then you're going to see pressure on gold. You're going to see pressure on silver. You're going to see pressure on copper, and not because anything's changed, just because all that free money that the Chinese have to throw into commodities, because I think they're going to go up because of demand. Well, they might not be so willing to do that now if other economies around them are weakening. Just an idea. Okay, so let's get on to what we're doing today. The Rise of Hard Assets is the title of an investor report by Crescat. And they're usually a good read, and the charts are always visually appealing and informative. So what we're going to do today is I'm going to go through a couple of those charts for you, and I'll go through the rest of the charts in premium with first, second, and third level takes. So the first level take would be the title and what it's about. The second level take would be the first interpretation. The third level take would be the implications for the market. Okay, so let's go. Let's go to it. Front page, why doesn't he want more of the gold? We pretty much explained that, as well as went through the Bank of America report yesterday. Options masterclass, this is very academic, but helpful if you want to understand those reports by Zero Hedge and Spot Gamma that are about options gamma, clenching and unclenching. And I had a CFTC note that I put out for everyone yesterday. So a lot of content over the last 3 days. So here we go. Here's a set. There's like 24 charts, okay? And the charts are always good to look at. And the writing is very good as well. But let's go through a couple charts. I'll give you an idea of what we're looking at here. Make it easy on everyone. All right, China's gold rush. Oh, I got to make this bigger again. We're not fitting, are we? Hold on. There we go. Let's just start with the date. Okay, so here we go. China's gold rush. The resurgence of gold gradually, then suddenly. You can see that as China reduces its holdings of U.S. Treasuries, it increases its holdings of official gold reserves. That's level one. Level two is, well, they are putting a portion of their sales and treasuries into gold reserves. That's a correlation, and I'm telling you the causation is something else, but those two go hand in hand. The third level is, well, they have a lot more to go. You know, the bottom of that chart is not the bottom of their selling. Anyway, nice little chart depicting, and you can ask yourself what happened and where did this start to happen? Well, it actually happened back here and then was stopped here. See this dip here? I'll give you, here's a nice little third level thing here. In 2016, they sold a lot of treasuries and they bought them back. Well, why is that? In 2016, the yuan was admitted to the SDR, the IMF's SDR. They had to do, this is a government playing some political games to keep everyone happy because the yuan had to be strengthened. And for whatever reason, they sold treasuries to prove a point and then they bought them back. Okay, so this, look, China's no innocent angel either. Everybody plays their games. Next chart. This is my favorite chart by them. It's my favorite chart because, well, U.S. treasuries are now more volatile than gold. Okay, so throughout history, pretty much, treasuries have been less volatile than gold, going back to 1980 at least. And the reason for that was treasuries have been less volatile because they have been framed or perceived as a store of value that competes with, if not outdoes or outperforms gold. And that has been the case since the great inflation of the 70s was squashed. However, that's a big deal. The trend is reversing. Now, the next level, the third level of that comment would be, well, these aren't gradual trends. This is not noise. This is a fundamental change in the market being reflected in volatility. All right. If gold is less volatile than treasuries and you're a big country and you need to put your money in something that's a safe store of value, that's a less volatile store of value, you're going to pick gold over treasuries. That's the cause and result of people getting out of treasuries into gold. Next, global gold production versus gold price. This is a nice little chart because it shows the price of gold simply going up when production goes down. Now, the correlation is definitely over the long haul a causation. Over the short haul, it's hard to see that, but you could see right now that what they're looking at is that if production is dropping, maybe price is going to continue higher. And certainly that's something to look at over years, not over days or months. But it's a pretty good comparison there. Correlation. Gold goes up not just when the production goes down, but gold goes up when all the production is allocated. So there's really not a lot of gold. Here's what I mean. Gold was going up even while production was going up here. And that's because there's a scramble for it. There's not a lot of available collateral. So this may actually be a big, if this keeps dropping, this could be a huge kicker once people start to pay attention to the fundamentals. Next chart, three inflationary waves in the 1970s. There is an analog going around. Certainly I was one of the people doing that very early on, and that there were three waves of inflation. Most people focused on the second and third waves as being the first and second wave. But here's what we're looking at here. In the first wave of inflation in the late 1960s, it went as high as 6%, but the economy was doing well. So GDP was, let's say, 8%, and inflation was 6%, and everyone was working. And in the second wave in the mid-70s, inflation was as high as 12%, but everyone was still kind of working, right? But now we're in the middle of the manufacturing sector collapsing. So you're losing your job at the at a Detroit plant, and you're getting a job waiting tables. And the third wave in 70, between 70, this is one that I remember, between 77 and 82, you were getting fired, and the price of things that you needed to buy were going up. Now, people, so they contend that we are at the end of the first wave. And you can't argue with that analog. The other analog is that we're at the end of the second wave, and there really was no first wave, where the first wave happened in 2011, right? 2012. It's hard to say, but you're at the end or the beginning of a wave, that's for sure. If you believe, and here's the third level comment, if you believe that inflation is going to return and the government's going to keep spending, well, then you believe that we're at the beginning of the second wave. If you believe that we're at the beginning of the third wave, then you also believe that the government's going to change and we're going to get fiscally tight again. Now, I don't believe that the government's going to stop being fiscally loose for the next 3 to 5 years. So I would have to tend to agree that we're somewhere in here. Now, I really hope we're in here. Whereas it gets worse, the government comes to its senses. But I don't think the government can come to its senses. So I'm defaulting in this area somewhere. Next, history of gold cycles. There's no real second and third levels to go through, but it's a nice little history piece there, leaving that up there for everyone. There are many other charts, and we're going to go through the rest of those in premium with that second and third level commentary. But here's a link to the actual report. And it's not just charts. It's not just pretty. It is pretty, but it's not just pretty. Right? There's a lot of argument here about the rise of hard assets, and they're all good arguments. They're fleshed out comments that things that other people have said, but they're touching base and letting you know that we're in the process of happening right now. So there's your charts embedded. It's a nice little write-up, and of course it has their performance as well. Okay. Market news, going to market news. U.S. manufacturing activity slowed for a second straight month in May as new good orders dropped by the most in nearly 2 years. So now look at the markets. The markets are saying, well, we think that the Fed's not going to ease, if you want to look at it through that lens, and we're a little bit worried about that. So things are weaker. Here's a good one. Tinfoil hat moment. An apparent glitch at the operator of the New York Stock Exchange triggered volatility trading halts shortly after the open in about a dozen companies. Well, this is completely correlated and probably related, if not exactly directly related, to the GameStop fiasco. Roaring Kitty, I forget his name, Gil, he put out something on social media implying, though not saying anything, that the GameStop open would be strong, and the GameStop open was strong, and the New York Stock Exchange had a glitch. It's kind of like, oh, yeah, let's unplug the market because we don't want things to get really too bad. And that's when I looked at it. Berkshire Hathaway went to zero on the data, and all the data feeds at mainstream media were bad, and they were literally putting out stories saying Berkshire Hathaway dropped 100%. I should have the picture to that, but I don't. It's amazing. Geopolitics, mostly Israel. It's not in here, but they're bombing Aleppo now, and that's where this all started in 2016, the whole Syria area. Okay, data on deck today is factory orders. So you're going to get a lot of PMI, ISM type of data today. Tomorrow is ADP unemployment. In the premium at the bottom, I have all the charts, and we're going to start broken out from the S story. We also have the story as well, but we're going to go through that in a minute. But first, let's take a look at gold and silver, okay? So nobody gets freaked out. Now, on a monthly basis, on a monthly chart, I know those 2 wicks there can be frightening if you're a real technical analyst, but it's not a disaster because it's a higher high, and pretty much it didn't confirm it, but it didn't negate it as well. It's not necessarily bullish, but you won't know until the month is over on this chart. So let's bring it in a little bit. On a weekly basis, it's a trading range until we get below this area, which is an area I marked off before. This is where that big buyer was before. We're fine. It's a big trading range. Don't sweat it. On a daily basis, if the market can hold above here, that trading range bottom where the buyer was, and this gets to oversold, to give you an example, like down here, which happened in February, then you have another March 1st. So we would like to see the market, if we're bullish, and we are bullish, to trend sideways, ideally hold in this area while this drops, but more likely at least have a test of this area while this drops. You have too many longs on the speculative side. Too many is a subjective term, right? It's too many if they lose money. It's too many if you want the market to go down. It's not enough if you want the market to go up. You follow? So, just ignore the press if you can. All right, silver. Let's stay with daily and go to silver. All right, silver, right? This is what we had a couple days ago. We had the sell-off that was accompanied by gold. We had the rally that gold did not participate in, and now we're back to where we started. This sucks, okay? I'm not saying it's bearish. I'm saying it sucks because when gold sold off, silver sold off. When silver rallied, gold rallied anemically, okay? And my hope was that silver stabilized up here and it dragged gold higher because gold is the metal everyone wants. Unfortunately, the selling came back in gold and it dragged silver down with it. So what's going on behaviorally? Behaviorally is macro discretionary. Macro discretionary took some of their gold profits and put it into silver with a vengeance when it got near that $30 area. And that drove the market up, and some people got really hurt. Unfortunately, then they sold some more gold out. So if you want to play the game, then this is where you buy silver, right here, right now. Or you let it go below this high and then close back up on a daily basis and expect us to go to the top of the range. So if you're bullish, you see this as the bottom of a range. If you're bearish, you do nothing until it gets below this area, and you could get chopped out as well. So silver recoupling with gold on the downside, gold recoupling with silver and dragging silver down really sucks for the short term. However, where this oversold, the RSI is here. Last time our RSI was here, we were trading $26, $27. Okay, so maybe $30 isn't support, on a day-to-day basis, but $30 is an area of interest. And, you know, if this market is holding $28 and RSI is somewhere down here, the next leg is going to be higher. Remember what Michael Oliver said, you're going to have 5% pullbacks. You're going to have 10% pullbacks, but we're in the time set, the acceleration phase, he believes, right? So on that note, if you're looking at the acceleration phase, you want to actually go out to the monthly. That's kind of what he prefers. And you say, you know what? Bad start to the month, but this is not bad. Look, market makes a high, RSI makes a high, market makes a new high. It doesn't look as great in that last week. Last week was horrible. Look at this month. This is ridiculous, right? This is a very strong market on a monthly basis. In terms of months, it's not where silver opens, it's where silver closes that matters, right? So it's a bad start to the month. It's a bad end to last week, and it's a bad start to this week. You got to expect this market to pull back. I mean, if it doesn't, then it should moon, because this is not a range. It can't be happy in this range. Okay, stay with us, and I'm going to go through these charts, the rest of these charts in premium. Presently, I do want to mention something about oil. We're going into an election, and you may or may not agree with me on the level of suspicion that I have, but I have seen elections come and go, and usually when they come, whoever the incumbent is, as they approach their convention, the commodity oil drops. How's that? I started first noticing it with George Bush when he was running for re-election. Oil just cratered as we were approaching his election. I think that's the incumbent party saying to the Saudis or to their own sellers, we don't want to have inflation or high oil prices in the headlines as we go in with our marketing plan. And I think that's happening now. A little bit early, but geez, yeah, it's happening a lot. So be careful. The CTAs are also short oil and making money. So CTAs are making money right now. I think they're selling their gold and now they're getting short oil, which is goofy, but there you have it. That's the way to do it, I guess, if you want to make money. All right, stay with us, and we'll go through the rest of those charts now. Okay, everyone. Let's go to it. We went through China already. I duped myself and put China in there again. All right, money supply versus central bank assets. Now you say, okay, money supply is going up while assets are going down. Well, why are they going down? Are the assets going down because they're selling them off? No, they're going down because they're going down in value. So what you see is more money out there and their balance sheets deteriorating. It's like your house is going down in value that you own, but your payments are going up because printed money is owed money. The Big Mac Index. The Big Mac Index is still fun to look at, but economically, you want to focus more on something like an iPhone. And the Big Mac Index is a good representation of purchasing power parity. So when you're trying to look at currency versus interest rates, you're like, oh, the currency's weaker, but the rates are higher. How does that equate? Well, it equated with the Big Mac for years because all the parts that went into it were sourced in the country. They didn't fly them over from the US. So the meat was local, the lettuce, so much of it was local, and therefore it was a good reflection of that economy. So to get a Big Mac in the US, let's say cost $2, to get a Big Mac in I don't know, Slovenia, let's say that also costs $2 in terms of the equating, and that would be $2. A Big Mac is a Big Mac is a Big Mac wherever you go, and it worked because the The ingredients were sourced locally. Really, this is something, probably the only good thing, in my opinion, that The Economist has ever done is, I think this might be The Economist origin. But anyway, to the extent that a Big Mac is different in price, and assuming that everything is sourced locally, then that'll give you an idea of your true purchasing power parity. So it's a good way to do apples to apples. iPhone's probably better now, but there you have it. Commodities to treasuries ratio, technical chart. Tavi likes to do downwardly sloping lines and show breakout points, and certainly it's visually appealing. And it does not lie in terms of the big trend, right? You don't make a day-to-day decision on this, but you do say, you know what? All that big picture stuff Vince talks about, well, this chart is really kind of showing that to be right, you know. US versus China GDP. So you have nominal GDP, I should say, in US versus China. You can look at this and you can say, well, the US GDP is doing better than China. Now, the bull case for the US, bear case for China is the following. China is entering an era of potential Japanification, okay? A lot of printing, low interest rates, but no real economic push. That certainly is the narrative coming out of the West, and there's merit to it. The other narrative is that's nominal. That's nominal GDP, right? Take out the currency differences, and China's not doing so bad, okay? Well, forget about China. As an American, look at this, or as a Westerner, look at this. Yeah, our GDP's up. How much of that is inflation? Okay, that's the way to look at this. If you're trying to balance out your opinion, my opinion is buy gold, because if there's a deflationary recession hitting China, then everyone will freak out and buy gold. If there's an economy that's going to overheat because of us, buy gold. All right. Now, the thing that makes you not buy gold, the only thing that makes you not buy gold, and it's a big thing, is if China starts weakening the yuan but retaining their peg to the dollar. And that means they will sell gold. Okay. But I think China is moving towards a sort of implied gold peg. And in doing that, they don't care if they depeg from the dollar or de-link from the dollar, because they're linking to something, in their opinion, that's better. So I'm bullish gold because of that, even with potential Japanification. So if the Western narrative is right, yeah, that's going to dampen gold's rally, but it's not going to kill it, because we have our own problems, dude. Copper adjusted for gold prices. I'm not. This is really good stuff, and I don't follow it as much as I should. I used to watch it very closely with Gunlock. Gunlock would do copper versus gold versus a 10-year yield, and I was a big student of that. But copper versus gold itself, I don't feel that is truly economically informative. However, visually, this is a good point. It bottoms in here, and it makes different types of tops. You want to call this a top, and you want to call that an aberration. Well, this is not an aberration if that's an aberration. So, we're closer to a bottom than a top. I wouldn't take this directionally anyway, except that we're in the middle of a range that's been going on for 13 years. Metal prices versus producer capex. This is an interesting chart, and it confirms something that many people have said, myself included, but from people that know the mining industry better than I do. After getting there, well, let me just, second level. Second level is prices are up, and the amount of money being spent by miners on new sources of production is really not. They're not spending money to grow. They're not growing. All right, so there's a lot to take out of this if you know the fundamentals, and this is very cool, I think. Miners in general have gotten their asses handed to them for being so poorly run over the last 30 years that they have pulled in the reins and have stopped spending. So your bigger miners are like, screw that, I'm not going to do any capex anymore. They say, you know what, I'll just wait for someone else to discover it, and if I need it, I'll buy them, right? So this is actually a sign of responsibility. They've outsourced their R&D, so to speak. And they'll buy them if they need it. So I think this is actually, I don't think look, if this CapEx climbs, I don't know what that means. It could be good, it could be bad for individual companies. Are they spending it on actual mining research, or are they going out for hookers and blow? Like that's where you got to know your fundamentals. But I think this is a sign. This is a sign of mining companies continuing to be responsible. Chile copper production. Yeah, are they drilling less, or are the mines losing productivity? I don't know. You have to look into that. All right. Next group of charts: gold versus copper miners. This is also a great chart. So this is the price of gold versus the price of copper miners. Copper miners are in red. Copper miners are outperforming gold miners, and that is a combination of reasons: costs, productivity. But the big things now are the narrative of green, right? If you're going to do net zero or something approaching net zero, you're going to retool the economy power-wise, you need more copper than you need gold. So people that are in equities are buying copper miners, not gold miners. That's what that means. Next level, if you're a big gold miner and you want to have a diversification of metal as well as the brand of green, you're buying a copper mine. Big miners are going to start combining. Other big miners are going to start diversifying. Depends on how they look at it. So pay attention to what your shares are doing or what your companies are doing that you own. Gold and gold miners as a percentage of global assets, it's low. And you know what? See this year, 1921, 32, 48, 81. Watch. 10 years, 15 years, 40 years. What happened in here? You follow me? I'm not suspicious of the chart. I want to say, what happened in here? And if you show this, if you show the trend from 81 to 24, it's going to be lower and lower and lower and lower. And why did that happen? Because the miners were run like shit, number one. Number two, other innovations came along in other industries that made them more interesting. Technology, oil fracking, okay? But, if you want to compare it to this era, it should be higher. Do I think it'll get up to this era again? I don't think so. But is it ridiculously low? Of course it's ridiculously low. We need metals more than ever, right? I mean, what oil was to the last 50 years, copper and silver can be for the next 50 years. So this is a ridiculously low number. Moving on. Precious metals industry performance. Well, there you have it, right? Okay. Nothing really to say about that except it is what it is, and that's a reflection of the risks, both real and imagined, in the mining industry. Gold holdings as a percentage of foreign reserves. Tommy likes to do these lines, extrapolating, and he's not wrong. He's not wrong. I mean, we've seen the other trends. This is a nice little visual say that, hey, we've got a rounding bottom here, and it may or may not get up to this level, but until it gets, if you want to do a technical thing, until it gets below here, this is a very nice rounding bottom. Maybe we'll get a cup and saucer, a cup and saucer, a cup and handle out of that. Earnings yield on 60/40 portfolios. This chart is, I think this chart, well, it shows the earnings yield cycle of 60/40 portfolios. So your portfolio is 60% stocks and 40% bonds. How does it do during extremes? I think that's very informative. So to put it at second level simplicity or explanation, the top is when things are going bad, the bottom is when things are going good. Okay, so when the economy is doing poorly, things are going bad, things are up here. And when the economy is doing well, things are down here. Why is that? Because this is about dividend yields, right? This is about income, right? So when stocks and bonds are destroyed at their worst, bottom of the Great Depression, end of the stagflationary era, that's when things give you the biggest yield. And when you think about this, 1981, See this line here? This is the bond market. This is the bond bull market right here. Yields continued to drop on portfolios because stocks kept rallying. This drop in yields is an increase in capital gains. Phenomenal run. And, a lot of people believe, and they could be right, that this is HeartNet, for example. This is the beginning of the next big bond bear market, right? So I know this is 60-40, but just look at it from a bond perspective. Bond bear market, the 40-year bond bull market. Wow, right? Bond bear market, right? And, you can look at this in here, bond bear market as well. Bond bear market, bond bear market, bond bear market. So, right? Change the scale a little bit. Bond bear market, bull market. I'm just looking at the bears here, right? Cycle. That's not really a cycle. This is like a disaster. Cycle, and this cycle could be way worse. You see that? I mean, it doesn't take a lot of imagination to see that. And I just fucking love this chart. This is a manifestation of the world saying, this is not gold being less volatile than treasuries because of financials or because of panic or because of manipulation. This is gold being less volatile because of treasuries, because people say, I don't want the treasuries anymore. We don't trust the United States anymore. We think the United States might sanction us. We think the United States might be politically unfit. We think the United States is not the economic power it was. We think your treasuries are not the store of value they once were. And the volatility increase is not just because it's dipping, it's because it's dipping and the US is supporting it. It's dipping. So one country sells it, we support it. Meanwhile, gold is just marching, right? What happened to those big 2% dips, those big 4% dips in gold? Anyway, very passionate about this chart. Foreign central banks transitions toward gold. Okay, see this histogram here? This is basically that bottom graph that Tavi had before, and this is excessive treasury issuance without major buyers. I'm not sure of his calculations on this or where he gets it from, but what the chart is showing is that treasuries are being offloaded while gold is being bought, okay? Excessive treasury issuance without major buyers. I don't know that this chart is reflecting that, but let's assume that it is. He's basically saying that more treasuries are, and he's right, more treasuries are being issued with less foreign buyers taking them down. And you can see that in the weekly math. Top 10 gold miners, average grade for existing gold reserves. Okay, so gold reserves, grade of gold that's being pulled out of the ground is decreasing. And you can look at it from here to here. I would like to look at it from here to here. Okay, and you could say, well, 2011 was a high. This could be the high. Look at it from here to here. That's a high, right? And gold came off. You could say, well, then we started another cycle. Look at it here. That's a high. Well, normally I would say you should be looking at this cycle and this cycle, right? Low to high in the market, high to low in grade production. Low to high in the market, high to low in grade production. But this line here implies from here to here. Now, he's not wrong, and he's not wrong because, well, the chart itself, it doesn't really mean much to me, but I don't admit I'm not a mining guy. But what happened in 2011 was almost entirely gold and silver rally, or gold rally, because the euro was in jeopardy because of Grexit. Okay, because it was a shit show because they were worried about Greece coming out and other countries, but Greece was in major trouble. That's when gold and silver rallied, coincidentally. Now, that was the culmination. Do you think we're at the culmination geopolitically of the problem here? There's no way. You think the US and Russia are going to be shaking hands tomorrow? No. So I think this line applies. Global gold production versus gold prices. I went through that already. Where's that? Next set. Metals and mining industries, aggregate capex adjusted by GDP. I already made my comment about capex.